Yes, the guys who claim, and there's many of them, and analysts and investors, that when the stock market goes down, so does gold. People think it goes with the stock market. Gold is a monetary metal. It is the inversion of the collapsing, ongoing collapse. Well, we've been waiting for the stock market to top because the technicals have told us this is the biggest bubble in stock market history that ended early this year. From 2009 to then, 15 years of massive multiple upside caused by monetary policies. We know QEs lasted for, we had free money for 10 or 15 years. And even when they raised rates, it was lower than it had been in 50 years. So, it was free money. Okay. When you have free money, it goes somewhere. And it went into the stock market. Investors now are deciding maybe they don't want it there. Okay.
Good evening, ladies and gentlemen, and welcome to your exclusive economic briefing. Tonight, we're bringing you one of the most critical updates in the world of finance, precious metals, and monetary policy. Gold is surging. Silver demand has exploded by over 800%. The US dollar is weakening, and Wall Street completely distracted. Meanwhile, global central banks are shifting the foundation of the global financial system, and most investors haven't even noticed. Tonight's AGI report features seasoned financial analyst Michael Oliver, a longtime voice in monetary policy and market trends. His message is urgent. The window of opportunity in gold and silver is still open, but not for long. If you've been sitting on the sidelines, now may be the time to act. Let's begin by stepping back and looking at the broader market landscape. Michael, Oliver says the U.S. stock market is in the final stages of a bubble inflated by 15 years of near-zero interest rates, quantitative easing, and free money policies. From 2009 until early this year, stocks climbed relentlessly, driven by massive injections of liquidity from the Federal Reserve. But those days are over.
Yes, the guys who claim, and there's many of them, and analysts and investors, that when the stock market goes down, so does gold. They're too much focused on a narrow event in a brief period of time. The last time where this occurred, and they still remember it, is that October of 2008. At that point in time, gold had already been rising since its lows in price. In the year 2000, 2001, it was about $260. It went up all the way to 1,000, okay, quadrupled. And that was before that collapse in the stock market. And in fact, part of that was while the stock market had already topped and was headed down. The stock market had been dropping for a full year, and gold still rising. But in the summer, especially in October of 2008, the stock market finally had a sharp drop within the context what was already an ongoing bear market. It dropped like 30% in a month, okay, October of 2008, a year off the high. At that point, gold said, I'm going to correct too. I'll use this as a correction opportunity. And it had a collapse down into the 600s. And people think it goes with the stock market. Gold is a monetary metal. It is the inversion of the collapsing, ongoing collapse in the real value of paper money units. Yens, euros, dollars, you name it. They always depreciate because governments always expand the money supply. They create free money, artificially low price of credit, and it creates distortions. And gold is merely an ongoing reflection of the decay in the monetary units that we use. That's still going on now. Money supply is still growing. It basically doubles almost every decade. And when the Fed has an excuse or justification, which is what they were created for, to save certain institutions, banks especially, they push the pedal to the floor. Now, the Fed is going to have soon all the data points they need to smack them in the face to, again, push the pedal to the floor. And I know they don't want to because, frankly, they don't like Trump. He doesn't like them, so there's an antagonism there. And so Powell's kind of smiling right now because stock market's going down and he's not getting blamed for it by keeping rates too high for too long. Trump is getting blamed for it.
According to Oliver, the technical indicators have signaled the top. The bubble has burst. And as money flows out of equities, the question is, Where does it go? Many analysts claim that gold moves with the stock market, that when stocks crash, gold crashes too. But Oliver says this is a misconception based on narrow short-term observations. In reality, gold is not a risk asset. It is a monetary metal, the reflection, or rather the inverse, of collapsing paper money. Take the early 2000s, for example. Gold rose from just $260 to over $1,000 an ounce. That's a four-fold increase, even as the broader stock market struggled. Yes, there was a moment during the 2008 financial crisis when gold briefly dipped, but it wasn't a breakdown. It was a correction, and shortly after, gold resumed its upward march. What we're seeing now is a similar scenario, but on a much larger scale. Oliver emphasizes that gold is responding not to stock market volatility, but to the decay of fiat currency systems. As governments continue to print, dilute, and inflate their currencies, gold steadily reveals the truth behind the numbers.
Well, gold's up over $250 in the last 3 days.
Yeah.
Right. So we're accelerating. Last couple of days, we were $100 a day, and maybe we'll be up again. Maybe we'll be up another 100 by the time, they close today's trading. But what's happening, and what I've been telling people was happening all last year, as the price of gold went from 2,000 to 3,000, and nobody cared, and nobody was buying it because everybody was, sidetracked by Bitcoin and all the talk about digital gold. Nobody but foreign central banks were buying actual gold. And the reason they're buying gold is because they're getting rid of their dollars. They are preparing for a world where the dollar is no longer the center of the monetary system, where it's no longer the reserve currency. And so if you're going to get rid of dollars, what do you replace it with? Well, gold is the most likely alternative to the dollar. And that's what they've been doing. Although I think recently central banks are probably also adding euros. My guess is that the Bank of China is buying euros as it may be selling dollars, because I think they need to replace Americans as customers. And the Europeans, there's more Europeans than there are Americans. And now that the euro is at a 3-year high and soaring, the Europeans are getting richer as Americans are getting poorer. And so all those goods that China can no longer export to America, they can export those goods to Europe. And as a matter of fact, China is not going to be importing any more goods from America. And so they're going to import a lot of the agricultural products or other raw materials that they used to get from us. They're going to import them from South America. And so now those countries are going to be richer because they're going to have more export earnings. And now they're going to be able to afford the goods that China is no longer shipping to America. See, Trump really overplayed his hand. He thought he had the cards. He had nothing, because it's easy to replace consumption because anybody can consume. We don't do anything hard by shopping. The hard part is production. Supply is what creates demand. It's easy for China to consume what they produce or to trade what they produce with others. What's impossible is for America to consume what we don't produce. So at trade ends, America is stuck. All we have is paper. And that's why inflation is going to go through the roof in America, because we're going to have all this money with nothing to buy. And eventually Americans are going to start buying gold. I mean, they've been selling gold. They've been selling gold stocks. But, I've been telling people to buy gold, for over 20 years. When I first started recommending physical gold to my clients, it was under $300 an ounce. It's gone up more than tenfold. In fact, gold has outperformed the stock market for the last 25 years dramatically. I think the S&P is down maybe 65% priced in gold. So the whole bull market is an illusion created by inflation. Gold lets you see economic reality. But really, for the first time in my career, I'm actually telling people that for now, don't buy physical gold. Just wait. Because even though the gold stocks are at new 52-week highs and they're up maybe, 15, 20% and they're jumping finally. But gold stocks are much lower, than they were a few years ago, or 10 years ago, or even 20 years ago, a lot of them. Gold stocks are dirt cheap. And the reason for that is central banks aren't buying gold stocks. They're just buying the physical gold. but they buy the physical gold that the gold mining companies produce. And their profits are about to skyrocket because oil has never been this cheap in history relative to gold. That is the biggest cost for these mining companies. They're trading at single-digit multiples. Gold mining stocks have never been this cheap, not only relative to gold, but relative to the S&P 500. They're giving these stocks away. When you buy gold mining companies, you're buying gold that's still in the ground. And gold in the ground has never been cheaper in all of history than gold above ground. Mm-hmm. And so what I'm telling people now is, look, I think gold's going higher. Gold could hit 4,000 this year, but that's not that big a gain from 3,250. But I think if gold does hit 4,000, gold stocks are going to catch up. That means they can go up 5x. So rather than making 25%, make 500%. By buying the gold that's still in the ground. So for now, I mean, I don't know how long this sale is going to be going on. I expect a ballistic increase in these gold stocks. I mean, that's what I've been buying myself mainly. I've been adding to my gold stock position. Well, I'm buying everything. We own a lot of the royalty companies. We own a lot of the exploration, the juniors, the big producers. Look, the senior companies are ridiculously cheap. Their earnings, their Q1 earnings are going to be good, but their Q2 earnings are going to be phenomenal. The ones that started in April because of the collapse of the price of oil and the rise in the price of gold. So the analysts are not covering these stocks. Nobody is there. The last major moves were downgrades. I remember in early 2024, like February or March, they downgraded Newmont. They downgraded Barrick and basically to sells. And the analyst said, the reason we're downgrading is because gold's at 2,000 and we don't see any upside. Everybody thought 2,000 was the top. Yeah. And I kept saying, no, 2,000 is the new floor. And so Wall Street has completely missed the gold trade. They don't have any money in these gold stocks. Again, they bought Bitcoin ETFs and all kinds of crap. Bitcoin, since it peaked in November of 2021, is down more than 30% in relative to gold. So with all these ETFs, with Super Bowl commercials, with electing the first Bitcoin president, with the Bitcoin Strategic Reserve, all that hype, and Bitcoin has gone down by 30% relative to gold. And nobody wants to acknowledge that. Bitcoin is in a massive bear market, but that's one of the reasons that gold stocks are so cheap, because people that should have been buying gold stocks were buying Bitcoin, either through the ETFs or through MicroStrategy or any of this nonsense. I just came out with a special report. People can get it for free at Euro Pacific Asset Management, Europac.com. A special report, the best way to buy gold, in which I really make the case that gold mining stocks have never been cheaper than they are right now, and that's how you got to buy gold. Even though gold's going to go up, the gold in the ground could go up much more. And then, when you triple, quadruple your money in these gold stocks, which I think you could do very quickly, then take some profits and buy more physical. Yeah. Even if the physical has gone up, it won't go up nearly as much as these stocks. So it's like a once-in-a-lifetime opportunity to take advantage of the fact that everybody's been asleep. And, the central banks have been buying gold, and they haven't had any competition from private investors. Well, when private investors wake up, especially the endowments and the pension plans and then the hedge.
He puts it bluntly, the money supply is still expanding. It doubles nearly every decade, and the Federal Reserve, whether it wants to or not, will be forced to return to rate cuts and money printing sooner than later. When economic data worsens and political pressure mounts, the Fed will slam the accelerator, just as it has in every crisis before. And when that happens, gold will rise, fast. In fact, it already has. In just 3 days, gold rose over $250. Daily gains have touched $100. And this could be just the beginning of a much larger move. But while U.S. investors remain hesitant, distracted by Bitcoin and speculative tech, foreign central banks are quietly buying massive amounts of physical gold. They are actively reducing their exposure to the U.S. dollar. Why? Because they are preparing for a future where the dollar is no longer the world's reserve currency. China, for instance, is restructuring its trade alliances. With the euro now at a 3-year high and the European economy showing strength, China is pivoting toward Europe and South America. American goods are no longer central to its import strategy, and if China no longer needs U.S. goods, it no longer needs to hold U.S. dollars either. This global shift means inflation at home, a weaker dollar, and a lot more demand for gold. Now here's where the opportunity lies. Despite gold's rally, gold mining stocks are still severely undervalued. According to Oliver, when you buy these companies, you're effectively buying gold still in the ground. And that gold has never been cheaper relative to the price of above-ground bullion. 1. Reason? Central banks are buying physical gold, not gold stocks, and retail investors, distracted by hype and headlines, have ignored the mining sector altogether. But that's a mistake. These companies are trading at single-digit price-to-earnings ratios. Their costs are falling, especially as oil, a key input for mining, has collapsed relative to gold. Profit margins are about to explode. And yet, Wall Street continues to downgrade them. Earlier this year, major firms downgraded top producers like Newmont and Barrick, arguing there was no upside at $2,000 gold. But Oliver disagrees. He believes 2,000 isn't the ceiling, it's the floor. And if gold rises to $4,000 an ounce, which he says is entirely possible this year, gold mining stocks could increase 5-fold. He also compares gold to Bitcoin, calling out a major performance gap. Since Bitcoin peaked in 2021, it has lost more than 30% relative to gold, despite all the hype, ETF approvals, and media buzz. And yet, most investors haven't noticed. This discrepancy, Oliver says, is why gold stocks are still so cheap. Everyone who should have been buying them was busy buying crypto, but the tide is turning. Michael Oliver's final message is simple. Gold stocks are on sale. It may be the last time investors see these valuations. And when the next wave of buyers arrives and the institutions, the hedge funds, the pensions, prices could explode higher. He urges investors to position early. Buy the gold in the ground now. Then, when the returns come in, roll those profits into physical gold. And that, he says, is the smartest way to buy gold right now. So, what should you do? Watch the earnings reports from senior miners in the next quarter. Look at royalty companies, junior explorers, and undervalued producers. Consider reallocating from speculative assets into real ones, because as the cracks in the system grow wider, gold is rising from the ashes. And if you're not paying attention, you could be left behind. For more insights, Michael Oliver is offering a free report titled The Best Way to Buy Gold at Euro-Pacific Asset Management. It's available now and could help you understand why gold stocks may be the best investment you can make this year. That concludes tonight's economic briefing. If you found this valuable, don't forget to like, subscribe, and tap the bell icon to stay ahead of the next move in global markets. In a world of paper promises, it pays to hold what's real. Stay informed, stay prepared, and stay ahead. Good night.